Hello friends, a very warm welcome to my channel. In this video, we are going to analyze a small cap company which is undergoing a business transformation, which is a manufacturer of plastic pipes, that is Kriti Industries. If you are new to the channel, please do subscribe and hit the bell icon. And if you are still not the member of our Telegram channel, do join right now, because in that we post daily market analysis and lots of exciting news, views and ideas. So let's get started. Kriti Industries is a piping solutions company. They manufacture various pipes like gas pipes, telecom ducts, submersible pipes, casing pipes and lot of varieties in agricultural sector as well as building material sector. They have a brand called Casta under which they sell their products. This is a very popular brand in the central Indian region. This is an Indore based company having presence in 16 states, but primarily their business is into MP and neighboring states, districts of Maharashtra and Rajasthan, and they get almost 80% of their business from this region. So this looks like a market leadership in one way, but in the other way, this leads to revenue concentration in terms of geography, and this also becomes a risk for this company. So they have more than 400 dealers and more than 500 employees on board, and they have a capacity of manufacturing up to 110,000 tons per annum. And the company is slowly venturing into new areas of business like drip irrigation sector. Now let's look at the history of the company briefly. They started off their operations in 1983. At that time, it was not a publicly listed company. They got listed in 1992, and in 1998 they started manufacturing PE pipes. In 2000 they started manufacturing HDPE pipes, and in 2003 they expanded their plastic power range. In 2004 they set up a new manufacturing facility for molding white goods, and in 2010 they started manufacturing micro irrigation products. 2014 they introduced the CPVC pipes in the building materials segment. In 2018 they realized their concentration in a defined region and they extensively started thinking about expanding into different other states. 2019 they enhanced their capacities of production, and in 2020 onwards the company has been focusing on a complete business transformation from focusing on just the agricultural sector to the building material sector, from diversifying from just one geography of MP to different states in the country. So this is a brief history about the company. Now let's talk about the management of the company. The chairman and managing director of the company is Mr. Shiv Singh Mehta, who is a veteran in this industry, has decades of experience of manufacturing in the piping industry. He is the founder of the company, has expertise in finance and business strategy. He is an electrical engineer and an MBA, and he has been the president of the Plastic Processors of India in the past. So he has been recognized by the industry as well. He has won the Arya Chanakya Award for Corporate Governance and Corporate Social Responsibility. This shows that the corporate governance of Kriti Industry or the Kriti Group as such is very strong. Now let's talk about the products the company manufactures. They broadly classify their products into different segments. The first segment is the agriculture segment, where they get their maximum revenue from. Under the agricultural sector, they manufacture products like RPVC pipes, column pipes, borewell casing pipes and various other pipes which are used in the agricultural sector. Next, coming to the micro irrigation sector, which they have started diversifying into, and they are focusing on it now for further expansion. They manufacture products which are used as sprinklers, in-drip irrigation and online drip irrigation. The third segment which they cater to is the building product segment. Now they are focusing more on this segment as the revenue from this segment is consistent over the entire year. Revenue in agricultural sector is seasonal, so they are focusing to diversify into building product segment so that they get consistent revenue throughout the year. So under this segment they manufacture products like CPVC pipes, UPVC pipes, drainage pipes and various other products used for construction of different buildings and structures. The last segment which they cater to is the industrial solution segment. In industrial solution segment, there are different wires and ducts which are run through the products of Kriti Industries, like fiber duct, fiber fly, fiber e-track. So like this, there are several products which are manufactured in the industrial goods segment. Now when we talk about their clients, they have been working with very well-known, renowned names, brands in the country as well as abroad, like Jio, Reliance, then Vodafone, Idea, Airtel, BSNL, all the marquee names in the telecom sector work with Kriti Industries. Then in construction also, if you see, Ramki Group is working with them. They are working with L&T. So there are a lot of well-known companies associated and use the products of Kriti Industries. This gives us trust over the company and its products. In terms of segment, if you see, the revenue is about 75% from the agricultural segment, as we understood that this revenue is seasonal. Industrial solutions contribute 14% to the revenue, building products only 10%, and micro irrigation just 1%. So the micro irrigation and building product segment are still at a nascent stage, and they are further adding products to these portfolios to expand their product range. Now let's talk about the industry in brief. In 2019, the government of India announced an investment of about $1.45 trillion towards infrastructure development in the country, and this will lead to extensive demand of the pipes in India. The PVC pipes market specifically, if you see, can be expected to grow at 4.5% CAGR up to 2027. The HDPE pipes, which this company also manufactures, this market is expected to grow at about 11.2% CAGR up to 2026. So the industry has good tailwinds. The domestic market for plastic pipes has been growing at a CAGR of about 10 to 12% in the last few years, and is expected to grow at about 12 to 14% CAGR in the next few years and reach a size of about 500 billion rupees up to FY24. The investments in irrigation sector has also been increasing. Earlier they were growing at about 9 to 10% CAGR, and in future up to FY24 expected to grow at a CAGR of about 8 to 9%. So the agriculture or the irrigation sector is also expected to grow very much, which will lead to more and more demand of the products of this company. Now let's talk about the competitors of this company. Among the larger people who are listed category, Astral, Finolex, these are the companies which are larger in size, and the smaller companies are Prince Pipes, Apollo Pipes, etc. So talking about them specifically, Astral, if you see, it has a revenue of about 4,000 crore, Finolex also about 4,300 crores. EBITDA wise, these companies have an EBITDA of about 19% in Astral and 27% in Finolex. ROC is about 30% and 35%. And in terms of valuation, the larger companies are trading at multiples of 9.5x times sales and about 2x times sales in Finolex. Astral obviously has been given larger valuation because of the consistency and performance over the period of so many years. Then the smaller companies like Prince and Apollo are doing a revenue of about 2,500 crores in Prince case and about 784 in Apollo. EBITDA margins of the smaller companies are 17% for Prince and 12% for Apollo. ROC is about 29% for Prince and 16% for Apollo, and they are trading at a multiple of about 2.85 times sales and 2.75 times sales. So these are about the competitors. Now talking about Kriti Industries, the revenue is about 500 crores. So this is a much smaller company compared to its peers. The EBITDA of Kriti Industries is just 10%, which is much lesser compared to its peers, and ROC is pretty decent at 31%. But because of the lower margin and inconsistency in performance, this company has been given only a multiple of 1x times sales, which is much cheaper compared to its peers. Now, how is this company better than the others, or what is the competitive edge of this company? The promoters have been into business for more than 4 decades, so they have extensive experience and expertise in manufacturing of the piping products. They offer a one-stop solution for their customers and offer a wide range of products which their customers require under one roof. They are one of the largest as a single location manufacturing capacity in India, and they have a production capacity of 1.2 lakh tons per annum. Their brand Kasta is very popular in the central Indian region, and they have a market share of 65% in Madhya Pradesh, 45% in Rajasthan, and 10% in Maharashtra. So they are quite popular in the central Indian region. In terms of their brand Kasta, it has a strong recall value, and that gives an advantage over the other companies in these regions where they cater to. These are the competitive strengths, but if you realize that these kind of qualities or these kind of products are provided by all the other companies which we have discussed, so there is no such great economic mode or competitive strength against its peers, and this is a very competitive space, and that is why the valuations of Kriti Industries are not that high. In terms of growth strategy, if we talk about, this company has certain strategies which they have in mind for growth in the coming years. In terms of capacity, they are very underutilized. They just use about 25 to 50% of their capacity presently, and they are focusing on using their capacity to the fullest so that their margins improve with the operating efficiencies. In terms of network, they were focusing on only the central Indian region up till now, and now they will extensively appoint dealers and increase their network of products in different states as well. In terms of consistency, they want the revenue to be consistent in all the quarters of the entire year. That is why they are focusing on the building materials segment. When they sell products under this category, they will have consistent revenue in the entire year. In terms of value, they will be adding more value added products to their product portfolio so that their margins improve, which are lesser compared to its peers. They have done a capex of about 30 crore, and this will come into commercial production in Q1 on FY23. So these are the growth strategies of this company in the next few years going further. So by adopting this strategy, they will be de-risking this model, and they will not be a seasonal company. They will have consistent revenues, they will expand to different geographies, and they will remove the risk of regional dependence on their sales. Now, what are the risks this company has? In terms of price volatility, the prices of CPVC and PVC resins are very volatile in the recent times, and due to the rising prices, their demand is drastically getting affected as the customers are deferring their sales to the future. In terms of weather conditions, their business is they get a lot of revenue from the agricultural sector. So in extreme weather conditions like bad monsoons or extreme rains, the agricultural produce gets affected. The farmers are not able to cultivate, and their demand of their products goes down. So extreme weather conditions are also a big risk to this company, as recently in this quarter of Q3 FY22, their sales went down by almost 50% because of the extreme weather conditions. There is a lot of competition in this space by larger companies which are more efficient than this company. So that is a very big risk to this company. And regional dependence of their revenue in just about 2 to 3 different states, about 80% of the revenue from these 3 states, gives also a regional risk to this company, and they have to overcome this by diversifying into different states in the country. After discussing the business of the company, the various risks and growth strategies, let's talk about the numbers. Starting with the Q3 FY22 numbers, their revenue went down from 220 crores to 118 crores, EBITDA from 28 crores to about 9 crores, profit from 17 crores to just 4 crores, and EBITDA margins went down from 13% to 8%, profit after tax from 8% to 3%. So the reason for this degrowth is extreme weather conditions in the areas in which this company gets maximum business. So this is a big risk to this company. In terms of revenue in the last 5 years, or including the trailing 12 months, the revenue has been more or less the same. There's not much increase in the revenue consistently. It ranges between about 400 to 500 crores. So since there is no consistent growth in the revenue of this company, the valuations are cheaper. EBITDA has been steadily growing. It has gone up from 30 crores to 67 crores, but again in the trailing 12 months, it fell down to about 49 crores. So there is again an inconsistent fall in the EBITDA of the company. EBITDA margins have been low compared to its peers. It's generating a EBITDA margin of just 10 to 11%, and the company is quite hopeful that they will continue to maintain a margin of at least 11% going further, because the promoter in his earnings call claims that the company is as efficient in terms of cost structure as the bigger companies of the same sector. In terms of profit after tax, the profit has moved up from about 9 crores to 36 crore in FY21, but fell down to about 28 crores in the trailing 12 months. It will be critical to see the Q4 results of this company. The profit after tax margins are again not very impressive. They range about 5 to 6%, and that too in the recent years. We should be quite watchful whether the margins continue to remain upward of 5 to 6% in the future, or they fall back to the old 2 to 3% category. Now coming to the balance sheet items, the equity is almost the same, about 5 crores, and reserves have steadily grown, although the company has been making smaller profits, but the reserves have consistently grown from about 70 crores to about 150 crores in FY21. The borrowings are more or less the same. They have about 77 crores debt on the balance sheet, so the debt is under control. If they don't have much debt. Trade payables are more or less range bound. They have about 150 crores. So there's no abnormal movement in trade payables. Fixed assets are almost the same because the company is not using their existing capacity itself to the fullest. Inventory has been a steady rise. The inventory is increasing as per the sales of the company, so there is no risk seen. The inventory days are more or less the same, but in the last couple of years they have increased to about 132 days. So this is something which we should be watchful, because increase in inventory days will involve more working capital for management of business. Trade receivables are about 40 crores. Debtor days are somewhere around 40 to 50 days. They've been falling to about 20 days recently, but the normal range is about 40 to 50 days, which is quite normal, about 1.5 to 2 months in this industry. Cash equivalents are about 23 crores on the balance sheet. Then operating cash flows have always been positive. So they range in about 30 to 34 crores in the last couple of years. Free cash flows have always been positive except in FY19, which went down to about minus 3 crores. and in all the years they have been doing some capex or the other, which is either the maintenance capex or some debottlenecking. ROCE has gradually improved to about 32%. Now again, we should see whether in the coming next couple of years the ROCE is maintained upwards of 30% or it falls down to the usual range of about 20%. That decides the performance of the company. The dividend yield is 0.19, so it's low, but still it's a dividend paying company. ROE is about 31%, which is very good. The auditors are Rakesh Kumar and Associates. The remuneration to executive directors is upwards of 5 crores, which is well within the company's act limits, but still looking at the size of the company is quite substantial. There are no material related party transactions in this company, but there are unsecured loans which the company has taken from the KMPs. Let's talk about the shareholding pattern. The public owns about 33% in the company and promoters hold about 66%. There are not much institutional holdings in the company. Slowly the institutions have taken just about a stake of 0.03 and 0.01 in the recent quarter. There is no pledge. Now let's talk about the valuations of the company. The last trade price is about 100 rupees and 52-week high and low is 65 to 158. The last 1 year the stock has given a return of 46%, last year's a CAGR of 64 and 5 years 20%. This looks pretty high because post-COVID the stock has given a very big rally. The market cap is somewhere around 5 crores, face value is 1, so the further split in shares is not possible for this company. EPS is around 5.5 rupees and PE comes to about 18 rupees. Industry PE, if you look at the smaller companies, it ranges between 10 to 30 and 5 years median PE of this company itself is about 16. The book value is 30 and price to book ratio comes to about 3.4x and market cap to sales is 1x. So the valuations in terms of market cap to sales appear to be cheaper, but these valuations are cheaper because the company is having a seasonal business up till now. The company is only doing a regional business for maximum of their revenue. They are not having consistency in their performance in the last few years. There is not much of growth in the company. Because of all these reasons and risks involved in their business, the valuations are cheap. So if you are hoping for a re-rating in the valuations of this company, the company has to remove all these risks from their business model and their performance has to be drastically improved and it has to be consistent in the future years. Then only we can expect a re-rating of valuations in this company. Otherwise, as the management has the aims and ambitions, they have had an ambition of about 1200 crores of turnover in the next couple of years, but now they are doubtful whether they are going to achieve it or not. So all this is happening because the performance is not consistent. So they are working hard, they are working towards removing all this risk, but if that happens and the performance goes up, only then we can expect a re-rating of valuations in this company. So just by looking at cheap valuations, it is not advisable to just jump into the stock and grab it. Looking at the chart, the stock has been consolidating and in fact it is going down, making lower lows, lower highs, and we don't know up till when this consolidation continues. It is not advisable to jump into these levels and just grab it. You can wait for the company to improve the performance and slowly start taking position. And in such stocks, it is also very important to have a stop loss, either a price based, range based stop loss or a moving average based stop loss or any technical indicator you can use and keep a stop loss, because if the company fails to consistently perform in future, you should be alert and you should come out of the stock because the stock has given a very big movement from the lower levels. So if the performance ends up being bad in the future, it may again go back to those lower levels, which will be a very high risk for you as an investor. So to summarize, let's discuss the thesis and antithesis points for investment in this company. In the positives, we see the company has decent fundamentals. They have market leadership in the products which they manufacture in the limited regions which they operate. They have a strong corporate governance and they have won awards for their corporate governance. Even when you hear the management talk in the earnings calls, you get a lot of confidence in the management. The management is talking towards de-risking their business model in terms of geography and in terms of product range to have a consistent revenue and during the entire year. The company also has great growth plans as they want to build more network and enter into different geographies to expand their business. In terms of antithesis points, you see that the business is making lower margins when compared to the others in the same industry. The performance over the last few years has not been so consistent. It's a regional business, so until they diversify into other geographies, it is a very high risk. and the sales have been impacted in the recent quarter because of the same risk. It's a kind of cyclical business as it's dependent on the monsoons, and there is intense competition in this space. So I'm not sure whether the company will be able to grab a pie of the market and take it away from the bigger competitors in the other regions. So these are the thesis and antithesis points. Considering these, I hope you will be able to take the right decision to invest in the company. So this is about Kriti Industries. I hope you like the analysis. If you like it, hit the like button and subscribe to the channel. Do share it with your friends if you like the efforts. And if you're not a part of the Telegram channel, please join, subscribe to the YouTube channel. Thank you for watching and have a wonderful day.